Good afternoon and welcome to this webinar with Castings PLC hosted by Yellowstone Advisory. We're delighted to have with us today Adam Vicary, the CEO of Castings, and Steve Mant, the Finance Director. I am going to hand over to Adam Vicary, the CEO of Castings, to start today's presentation.
Okay, afternoon everybody. So this is a final results presentation for Castings PLC to the end of March 24. We've had a pretty good year really. The numbers are there for you. A few highlights. The machine shop had a very good year with the new products for our main customers now fully embedded, and some improvements in productivity and good volumes. And we installed our first set of solar panels, which is anticipated to give 10% of the power for our machine shop. So we're quite pleased with that installation. The year was peculiar in some ways in that the first 9 months were extremely buoyant with very good demand. The truck customers, of which we're sort of 80% truck, they started cutting their schedules towards the end of the calendar year. And although we thought that we would see about a 10% drop off, in the end it's been about a 20% drop off, and that's kind of where we are today. So in some ways, it was a bit of a shame because it was almost a record profit. It would definitely have been a record profit if it wasn't for that slight drop off at the end of the year. So summarising that in a little bit more detail, the trucks backlog demand was normalised, and that ended up with a 5% reduction on the full year, but it was all in Q4. Was what we saw with reducing schedules. We continued passing on prices to recover labour costs and general cost inflation, albeit only 1.5% to 2% this year, and energy surcharges, which we pass on with no margin. Unfortunately, they're now dropping and probably have an impact of about 10 million on the sales line this year, which in all things being equal would have been margin enhancing just purely from the arithmetic, but with volumes dropping, it's probably lost in the overall performance of the business. We've seen good demand from the US. Some of that is truck, and we do continue to see the US as a potential growth opportunity for us, which had stalled somewhat with COVID, and then when the business being very busy. But we're now very actively engaged with US existing customers and I'd like to think some new customers. We're actually in with Cummins in America this week, so hopefully that bears fruit. So a little bit more detail again. We spoke about the customer side of things. Continued investment in our production facilities. Some replacement in our machine shop, where we had one type of machine which, on a cost per uptime of maintenance, was caused us a lot of grief. We're slowly replacing those machines with a much lower cost per uptime machines. We're almost through that investment process now. We've got one more machine to come in, and we continue with our robotic investments. We've got 2 projects ongoing, with a third following by on installation or use of artificial intelligence in and around certain inspection criteria, which can offer us both improvements in the process and some considerable productivity gains. And as the slide says, we were very busy particularly around the summer period, and we decided to actually outsource some foundry production during the financial year, which has now largely returned. And I've already mentioned about the input prices and the price increases.
Okay, so on this slide, it just bridges the revenue from last year, or FY23 to FY24. So overall, a 12% increase despite that volume fall. So you've got 10 million of revenue lost through the 5% reduction in volume. As Adam said, most of that, in fact, all of that comes through in the fourth quarter of the year. We've seen a continued shift towards more machined and value-added parts. So that pushes the average selling price up. So we've seen that add another 4.5 million to the revenue line. The big one is on energy surcharge, which did start halfway through last year, so second half of last year, financial year 23. But this year we've seen a full year impact of that, so that pushes another 13 million onto the revenue line. And then the final one, the 16 million, is bringing through any other surcharges and the price increases that we've applied to customers to get you to the 224 for this year, just gone.
And we are in a cyclical market. I've been asked during these presentations to investors, what's the reason why the truck sector is cyclical? And to be perfectly honest with you, don't know, but it always is. There always seems to be a reason, whether it's new legislation on emissions, whether it's oversupply, whether it's chips, microchips. There always seems to be a reason. But as you can see, it's a pretty cyclical business, and we're now in a bit of a downturn. That's how it is, really. We are looking with our new line, which we'll come on to in a bit, using the new line as an opportunity to perhaps win business outside of the truck sector to try and water down somewhat the cyclicity of our main market. But it is what it is. We roll with the punches, and we're going to have a quiet year. So be it. This shows the quarterly sales for the various years, and you can see if you compare the fourth quarter of 24, fourth quarters of previous year, you can see the drop off quite clearly there, and you can also see what is a bit of seasonality in that in the summer months, our main customers have typically 4 weeks of shutdown. So our busy period is often Q3 and into Q4. But this year that Q3 was strong, but Q4 dropped away quite sharply. So there's the 6 OEMs who we supply. You can get a view of those, the largest ones and the smallest ones. We supply every truck manufacturer on that slide, with the exception of Iveco, with Scania being our biggest, and then Volvo and Daimler / Mercedes being the next.
Okay, so this slide just brings through some of the KPIs for the year just gone and the prior year. Revenue, obviously, we've already talked about. Operating profit, as Adam mentioned, it's one of the strongest operating profits that we've had. I think it's the third best. An operating profit up 20.7%. An enhanced margin as well in the year, up from 8.1 to 8.8. Return on capital employed nudging the 20% level, which is the highest we've been since 2016. Dividends, as a lot of you will be aware if you've listened to these presentations before, we do like to have a progressive dividend policy. We're always looking to increase the ordinary dividend when we can. So we've done that again this year, which we're very pleased to be able to do. Supplementary dividend, we debated this as a board as to whether we would or wouldn't pay a supplementary or declare a supplementary this time. We have got a lot of investment coming through with a new foundry line, which we'll talk about in a little bit, and other investments. But reflecting the fact that it was the third best operating profit year in the history, we felt that it would be good to declare a special dividend as well, albeit it's a slightly lower level than the prior year, reflecting that CapEx to come through over the next year or so. So overall, cash was down 8.7% at 32.5 million. One of the metrics that we like to look at, because we talk about all the surcharges impacting revenue and operating margin. So actually, if you just strip it back and say, right, what's the profit per tonne sold? That's quite a clean measure of performance. So as you can see on this slide, I mean, you can see the COVID dips in 2020 and then through 2021. And then subsequent years, for the last 3 years, we've seen that increase each year, and at the highest level for a number of years at nearly £400 a tonne in FY24. This slide sets out that progressive dividend policy that I mentioned. So as you can see, increasing every year apart from the financial crisis of 2008-9. So yeah, 5.6% up this year. Plus you've got on the right-hand side there just showing the supplementaries that we've paid fairly consistently over the last four or 5 years. Then the next couple of slides just look at the two segments. So we look at foundry segment and machining segment and compare against the prior year. So overall, external revenue up 11.8% at 222.5 million. Volumes down 5% as we've talked about. Average selling price reflects a few things. That mix of more machined and added value parts that I mentioned earlier. Plus you've got the electricity surcharges having a big impact on the foundries, particularly because they are the biggest consumer of electricity in the group. About 90 to 95% of what we consume is in the foundries. And then you've got the other cost surcharges and price increases coming through, obviously pushing that average selling price up. So overall, a fairly consistent segmental result at 16.2 million compared to 16.3, and a margin on external sales down slightly at 6.5. And if you back out the electricity surcharge impact, that is more like 8.3% for the year. So again, down slightly, but at a reasonable level. Machining business has a particularly pleasing result for this year. From a revenue line, it's very focused on machining for within the group. So that external revenue at 2 million level is about what we'd expect it to be. That's not an issue. That's what it's there for. So a segmental result of 3.7 million against 0.2 million in the year before. So obviously a much improved margin, much improved EBITDA, and cash generative as it was the year before, at 2.3 million. CapEx, we are going through a bit of a replacement program, taking away some of the older machines that are maybe not core to what we do and moving that work onto what are more core machines. So a bit of a program on that. So that's pushed the CapEx up a little, and we'll keep it at a slightly higher level over the next year or so. From a cash flow perspective for the group, obviously enhanced profit levels help give you a good start. Depreciation pretty consistent at 8.5, 9 million. On the working capital, we were at the start of the year, stock levels on a tonnage basis were around about the 6,500-ish level, which is quite a lot lower than where we would like to be. So we have invested in that to bring the stock levels back up to a sensible level. So obviously that impacts working capital. CapEx for the group, 9.5. Again, reflecting that machinery investment program that we've been going through. There's a new foundry line, which there's very little impact in this year. That's more to come through in the current year and the year beyond, which we'll talk a bit more about in a little while. So overall free cash flow of 11.2, and then you've got the dividends paid out. So an overall net cash reduction of 3 million, to 32.5 million.
So this is a slide which gives a bit of an overview on the new line that we are in the process of building. It's a whole new foundry that we're putting in. Thus far, we're on track time-wise and on track as all the equipment has been ordered and placed in line with the quotations that we originally got. So that's all good. But we've only really started. We've cleared a building. We've done some preparation work. We haven't installed any plant yet, and we haven't really started the civils in anger. So there's a bit more to do really. So we'd expect it to be pretty much on time at this stage. We'd be a bit disappointed if we weren't. But this is our first foundry line since 2008. I'm sure some people are wondering what the justification is for putting another line down. I can sort of break it down into 2 or 3 factors. The first is, and one of the most important is, we are a foundry business. We should be investing in our foundry technology, and there is new technology available to mold making and foundry practices that we want to take advantage of, which this plant incorporates. Secondly, we're heavily into the truck sector. That's not a bad thing. It is cyclical, but it's been extremely difficult to try and win business in other areas when we are so busy. And although we've seen a drop off in demand, it doesn't take very much for us to be busy again, and we're always reluctant to bring in sizable other customers for fear that we'll be letting down our long-standing customers. The new plant opens up that opportunity to us, and hopefully over the next 2 or 3 years we will have diversified a little bit out of the truck sector into other areas such as the agricultural OE market, power generation, and wind energy, and so on. The other factor behind the thinking is that we are a green iron producer here in the UK. We are 100% electric melting. We're 100% recycled scrap, and we are 100% renewable power. That is the so-called green iron credentials, and we are one of the first in Europe. There will be others that will also be green iron, but there's also a large amount of foundry capacity in Europe which is still using metallurgical coke as its fuel to melt the base iron. That is going to become a problem to those foundries, such that we already have seen some, and we expect to see more consolidation. And we also expect it to offer some opportunities in that those that do make the transition are going to see cost increases and some technical limitations to their processes, and we do believe that's going to offer some opportunities. If we didn't have the new line, we wouldn't be able to take advantage of those, because we're so fearful that when our truck customers get busy, we're over busy. This slide sort of bolts onto what I was just saying. As well as the green iron producer, you can see that we've installed our first solar installation, which is really quite large, and we're quite pleased and surprised how effective it's been very quickly. We've appointed a head of sustainability. Our first sustainability report is imminent, and we've replaced now all of the individual machines in our machine shop, of which there's over 100, with individual coolers inside them, which are very energy inefficient, to 2 large externally positioned cooling plants, which are significantly more energy efficient and a lot more carbon friendly. We continue with our automation. You can see from the chart on the right that we started playing with robots in sort of 2016, 2017. We've now got over 60 robotic handling cells. They've really been a very useful investment for us. Our customers really like them. We've got more to roll out, believe it or not. We've got another 3 coming in the summer here at our Brownhill site. We've got additional robots coming in our machine shop, and we continue to explore and push the boundaries of other capable processes such as artificial intelligence, particularly in and around metal treatment and inspection. So you can see the mix of our main customers. We don't say who they are on here, but I can sort of shout them out. Our biggest customers, Scania, Volvo, and then Daimler and DAF. So what does the future hold for us? We expect the so-called normalized or reduced schedules to probably start to increase in the autumn. Our customers have flagged that. We'll wait to see if that holds true. Whether it does or whether it doesn't, the products that we have on the new Scania CBE engine will increase in volume, because the CBE engine for Scania will be supplied to MAN starting in 2025. So that offers us some improvements in demand, whatever happens. Some of the lighter duty truck electrification, we've actually won business on those vehicles, which is outside of our normal scope, albeit the volumes on the electrified trucks are very low, and the take up at the minute is quite poor. And as I mentioned, the new foundry capacity provides an opportunity for us to be able to go and market ourselves in the US more aggressively, agriculture, and opportunistic wind energy when wind energy projects are available. Energy prices are largely stable now, but with energy continuing to fall, that just gets passed on to the customers though. But we have been a little bit out of kilter here in the UK with Europe, and hopefully over the next 12-18 months we do get to a more competitive level with Europe. The capital investment, I think I've already covered. We've got some additional processes that we're going to be adding to the portfolio of products later this year. We already do a very innovative sealed manifold solution where we weld a stainless steel bellow onto our manifolds to give a 100% sealed system. And there are other processes that are going to come in and around that over the next 12 months or 12 months to 2 years, which we're quite excited by. On heavy truck electrification, I guess 4 or 5 years ago, I was more concerned about it than I am now. There's been little or no incursion of new technology in our sector. And the OEMs are really saying that they don't really have a solution yet. They've got an offering, and it's going to be a long time yet before the diesel engine, if at all, is eliminated from heavy trucks. It could well be that the hydrogen replaces diesel as a fuel, because the engines could be fairly simply converted to use hydrogen as a combustible fuel than diesel. So our strong balance sheet makes us very agile, gives us the ability to invest, take opportunities that come along, and we've also got the pension buy-in and buy-out, which perhaps Steve can just give a bit of an overview, unless there's another slide on that.
No, there isn't. No.
You want to just give a quick overview on?
Yeah, so the pension schemes, we've got 2 final salary schemes. Combined, they're in surplus to the tune of about 10.5 million. About 3 or 4 years ago, we moved to a buy-in situation to remove most of the risk, with a view to moving then to a buy-out and wind up of the schemes. That process is taking longer than we might have liked, going through GMP equalisation and things like that. But we are on course to achieve that, and I would anticipate by the end of calendar year 25 that we'd be completely done with that and the schemes wound up.
Yeah, so that will be another assistance to the balance sheet over the next year or two. So what are the opportunities? Well, we continue to drive efficiencies. The new foundry gives us the gives us the ability to try and spread our market risk a bit more, and also to assist our existing customers. The US market, we believe, is a big opportunity for us. We did very well there until COVID. Then COVID came along, and then we've been too busy. So we kind of kick-started that whole activity. Further value adding a house by some novel methodology in and around manifolds. And with the consolidation I referred to earlier, we do believe there could be some acquisitions that might become attractive to us. Okay, so we're just a little short of half an hour, which I think is what Alex said we would be. So I think that goes over to questions.
Yes, it does indeed. Thank you, Adam. Thank you, Steve, for that presentation, and congratulations on a good performance. Sounds like this year's going to be slightly tougher, but you've still got a few opportunities to look forward to. So, as Adam said, we're going to take some questions now. And just as a reminder, if you do want to ask a question, please type it into the chat box at the bottom of your screen. So let me start with something on a question of corporate governance here. Has there been any changes in strategy post the appointment of Alec Jones as chair?
No, not really. The previous chair was equally enthusiastic about the new line as the existing chair is. We're still, pretty conservative in the way we operate. So no real change, to be honest.
Okay, thank you. Question here on profit expectations. It seems like profit expectations could have been better handled for FY25. Why was this not the case?
I think it's always difficult. Our customers were signalling this so-called normalization of demand, but when pushed, they wouldn't give us what does that mean? And it's not until the schedules finally trot out that we can see where we're going to be. So I guess we did flag up that we could see truck demands being normalized because that's what we were being, that's what the market was telling us. I rather hoped it would be about a 10% drop, which would have had not a huge impact on the P&L. As it happens, it has been a bigger drop off than we anticipated. So part of that is they've caught up the backlogs and back to a more underlying position, but also that the demand in Europe is, particularly Germany, is quite depressed.
Thank you. I know, Steve, you commented on the pension fund, but we've got a questioner on it here, so I'll ask that. So it says both pension schemes are in surplus with a combined position of 10.4 million as at March 2022. Is it likely that shareholders will see any benefit from this surplus?
In short, yes. The quantum is difficult to say. Essentially, we have to negotiate with the trustees in terms of what happens to that surplus. Obviously, the trustees have to consider the members and the benefits being paid to them, and that ranks ahead of the company receiving any refund of contributions. So yes, there will be some, but yeah, quantum to be negotiated and agreed.
Thank you. Is it a strategic objective to reduce the cyclicality of the business?
I wouldn't say it's a strategic objective. I know we've supplied the truck sector for many years now, and we've been through these. Some of our investors have been with us for many years, and they've seen it before. I would like, if possible, to water it down a bit if I can. But if the truck sector come along and want half of the capacity of my new plant, and I can make a good return out of it, am I going to turn it away? No. So I'm not saying, but it does give us the opportunity to be able to start to move away into these other areas where the products are fairly simple, but it's fairly similar, but they're in a different market. But it's not a strategic intent that I'm definitely going to move out of this cyclicity, because the truck market is where we're mostly positioned.
Okay, thank you. I guess slightly linked to that, can you update us on your M&A aspirations? What areas are you looking at currently, and how much firepower do you have for acquisitions?
We've had a couple of years looking at aluminium businesses, if I'm honest, but I had this sort of thought that, we know the truck sector well. Why don't we look at other offerings into the truck sector? So we just have to deal with the supply side because we know the customer side. And it's not been particularly fruitful for a couple of reasons, really. The aluminium foundries tend to be either quite small or dominated by JLR, and neither of those are particularly appealing to us. And the one business which was potentially appealing to us, they weren't interested in playing ball. So we have had a look at other materials. And I think we've kind of drawn up stumps on the aluminium sector for now, but I do believe that as I say, the consolidation that's likely to go on will offer opportunities. Some sort of bolt-on thing would be more attractive to us than a full-on purchase. How much firepower have we got? Well, we'd like to keep circa 20 million on the balance sheet, so you can sort of do the numbers for yourselves.
Okay, thank you. Next question here. With the benefit of hindsight, what would you have done differently in FY24?
Well, I'd have built a foundry in 2022.
Got you. Okay.
I could have filled it last year. Anyway, there you go.
Thank you. Can you please give us some more detail on the opportunities in agriculture and in wind energy?
Okay, so we already do some work with agriculture. It's a very traditional product we've made for many decades, and they are really simple products such as seed drilling, consumable products, and plough point ends and things like that. It's not that what I'm looking at. I'm looking at the OEM agricultural machinery business. So large tractors, large farm machinery, where we don't supply anything at the moment. It's a huge market for castings. Typically, the products that we supply to the truck sector, believe it or not, in the agricultural sector, they're slightly bigger. And the reason for that is that in the truck sector, the engines are quite big, and they tend to have the products in sections. Whereas on the agricultural vehicles, the engines are not quite so big, but they're bigger than your normal passenger car, and the products are in one piece. So the actual individual products are quite large. And they're typicecally a little bit bigger than the existing foundry scope we have. So the new foundry plant has been spec'd to take into account the products we've seen in the past, which we've been unable to get into. So they are manifolds, engine brackets, and that type of thing for the OEM, such as John Deere, who we've just recently passed their quality audit. For wind energy, it's largely around cable protection. So when they stick a wind turbine out in the sea, they've obviously got to get the power back to the land, and they run cables, and the cables have to be protected. And the cable protection devices are typically cast iron. So we've had some quite nice projects over the last 2 or 3 years on this. And last year, when we were very busy, we had to turn down some of those projects, which was a bit disappointing, but we didn't have the capacity. Again, we can make most of these parts, but there are a range of these parts which are ever so slightly bigger, which the new line gives the scope to be able to supply.
Okay, thank you now. What causes the most heated debate in the boardroom?
That's a good one. In terms of heated debate, sometimes the discussions in and around, well, for me, it's what the actuaries are doing. I have a distinct dislike for with our pension fund, but yeah, we have some quite fruity discussions around what we do with the cash, to be honest, as you can imagine. But by and large, we're a pretty tight-knit bunch.
Okay, thank you. Are you seeing any demand for castings as rearmament takes place across Europe?
Yes.
Are you operating in that area at all?
Yes, we are. Yes, we are. We're doing. We've got one quite nice project with BAE Systems and another one following behind it. Not a huge amount I can say about it, but it is offering us some opportunity at the moment.
Okay, thank you. We've still got a couple of questions to go through, but just as a reminder, if you do want to ask any questions, please type it into the Q&A box at the bottom of your screen. Have you considered buying back shares for cancellation?
Yeah, we have. We've considered all options for returning capital to our investors, and it's a difficult one. We have some of our bigger investors like the idea of buybacks, but the vast majority prefer capital be returned via some sort of special dividend. So it's a sort of, we can't please everybody.
Okay, thank you. And we've got the last question here at the moment, which is truck demand had seemed to be underpinned for several years with manufacturers' new models, etc., as per previous castings updates. Why has this not sort of played out? And is it fair to say that castings seems slow to see trend changes?
There's not much we can do about it, Alex. Or to the question, the gestation period on putting tools down, having the parts approved, having them into the market is a couple of years. So it really is as simple as if our customers reduce their build by 20%, they're making 20% less trucks, we get 20% less orders. We can't just go and win business on the basis that we might see a drop off because we might not then have capacity. And that's where the new line comes in. Because I've felt a little bit sort of strangled over the last few years that we'd like to get some of this new business, but we can't bring it about because I'm beholden to the truck sector, which is not a bad thing. The company and the investors have done very well out of the truck sector, so we shouldn't decry it. But by the same token, when these downturns come, there's not much I can do about it in a short period.
Yeah, thank you. Well, we've got no further questions that have come into us today. So that brings us to the end of today's presentations from Castings. I'd like to thank Adam and Steve. Thanks for the presentation and answering all the questions that we've had submitted. And just wanted to flag up a couple of webinars that we've got coming up on the Yellowstone platform over the coming weeks and months. So on the 18th of June, we've got Oxford Biodynamics who are presenting their half-year results. And on the 18th of July, we've got Currys PLC presenting their results. So thank you for attending today's webinar, and we hope to see you soon. Thank you and goodbye.
Thank you.
Thanks.